Welcome back to another episode of Retire Right. I'm Ryan Wyatt. Today I'm joined again by Ron Wyatt and Nick Lewandowski, all wealth advisors here in the Pittsburgh office of Wyze Wealth Advisors. The content or the focus of today's episode is really going to be around the recent volatility in the markets. We really make a strong effort whenever volatility does enter the marketplace to proactively reach out to our clients just to see if they have any questions, see if they want to schedule a meeting sooner than we would typically be reaching out to them, just to provide some extra peace of mind or really comfort. This episode, I would say, is really going to just serve as kind of like an educational piece on what our thoughts on the market are and really the two different ways that we see how things could shape out depending on what the current administration decides to do. Gentlemen, anything else that you would want to add in terms of like what we're focusing on for the conversation today?
No.
Well, then let's just start with maybe kind of like broad strokes before we jump into the actual, bulk of the episode. What is the definition of a bear market?
What is the technical definition of
20% decline, right?
Okay.
That's, a correction is 10%, bear market's 20, and I don't know when it gets to 30, 40, or 50. I don't know what they call it.
Yeah, they all run together.
But yeah, it's ugly.
Yeah.
Just keeping you guys on your toes, adding a couple questions in here that maybe we didn't talk about beforehand. Can you, Nick, I'll give this one to you. Can you just explain what's been happening in the markets lately? Like, why is there so much volatility right now?
Yeah, so the cause for this selling that's been going on lately is tariff policy in the U.S. was very clearly the trigger for all this. If you read the news at all in the United States, it's impossible to ignore that's dominating right now. This episode, we did a separate episode on tariffs, so I'm not going to get into the whys and hows of tariffs. If folks are interested in that, they can see that other episode that we devoted specifically to that. But the market has been trying to get its collective heads around tariffs and what it means for financial assets and the economy for some time now. And there was an announcement on April 2nd was the day that the new tariff regime was officially announced. And the market did not like what it saw. Ron will give a little more detail about that in a minute here. For now, suffice to say, market didn't like it. We had a couple really big down days, depending on what segment of the market you were looking at, anywhere from high 4% decline to 7%. I think some of the small cap segments of the market were down on individual days, which are big down moves.
Oh, it's huge moves.
Huge down moves. And, the selling started in the stuff that had been the most overextended, which was a lot of the big technology stocks. And we had seen them coming back in really all of 2025 so far. And then it kind of migrated to become a generalized sell-off across pretty much everything.
It's really interesting. It's been the mega caps, the Magnificent Seven, plus a few others.
So the stocks that we've been saying for a little while are pretty expensive.
Right,
exactly.
Right. But also, which is surprising, is the Russell 2000, which is a measure of small stocks, has gotten creamed. I mean, really bad.
Do you want to hit on maybe why the small caps now, or do you want to cover that later?
We can talk about that a little bit later. Yeah.
Okay, perfect. So, essentially, in a nutshell, what's happening is the tariff strategy was announced, and the markets didn't like it, and so that's why we're seeing the volatility.
Right.
Why are the markets reacting so negatively?
Well, the tariffs were much more aggressive than expected. And what I thought was pretty interesting is Trump says, okay, we're going to tariff you, and if you don't tariff us back, like Japan, then we'll negotiate with you earlier. But if you put tariffs, on us, responding to us, then you're in the back of the line, like China, right? We put 34% tariffs on them, and they put it back on us, which is not a big surprise. And now they're in the back of the line and way of negotiating. So it's a unique tactic, very aggressive.
Trump essentially said, we're going to tariff you.
Right.
And if you tariff us back,
Reciprocal tariff, right.
There's going to be negative consequences what were those negative consequences?
Well, basically,
what's he saying those negative consequences are?
I think it's Israel and Japan have been, negotiating without putting tariffs on us, and so those are some of the countries that we're working with first to try to get a trade policy, an agreeable trade policy. Other countries that are coming back aggressively to us, I'm sure we're going to negotiate with them, but they're kind of in the back of the line, which is a pretty hardcore tactic, especially with how aggressive he's
So
being.
what do you think Trump is looking for? He's looking for no retaliation?
I don't know. Trump's really hard to figure out. He's doing some things I really like, which is cutting some government waste. Hopefully he doesn't go too far. I mean, there's obviously waste there. Protecting our borders. I mean, some really sensible things, right? This one here, time will tell. I don't think anyone knows now what it's going to look like. Maybe he's a genius and it ends up great, or maybe it blows up. Time will tell.
So I know, Nick, you referenced this earlier. I know in the podcast that we did specifically on tariffs, kind of painting both sides of the picture, how they could be good, how they could be bad. Mm-hmm. Some of the concerns, like in typical investor concerns, would be around economic growth and inflation. Anything that you guys want to mention surrounding that now?
Well, just when we have a tariff imposed on us, so like if we buy a product and the price goes up 50%, it's harder for people to afford, so that slows the economy down, and it's inflationary. Now, some people say it's a one-time inflationary event, and then we get used to it. But both of those aren't necessarily good.
Why a one-time inflationary event?
Because once the price is set up at a higher level, then going forward it should just increase by the rate of inflation. So it's like a one-time adjustment, and then after that you get used to it, and it increases hopefully by, again, the rate of inflation.
Is there anything that you guys think would be worth noting related to like bear markets historically? Like, what could you expect in a typical bear market?
Oh yeah, so we actually got data, and we focused on the S&P 500 just because it's a broad-based measure that most people who would watch this would be familiar with that as the U.S. index.
And
so,
just to elaborate, the S&P 500 is an index that tracks the performance of the 500 largest U.S. companies.
In general, the 500 largest, not like perfectly, but in general.
Yeah.
And so we went back and we looked at from 1950. Why did we pick 1950? We picked 1950 because 1950 really captures the post-World War economy. Prior to then, economically, globally, a lot of things were different, that maybe some of that market data isn't applicable to today. Like, I don't know if you go back to 1890, we have market data then, but I don't know that it is as relevant to what we can expect as investors today based on how economies and markets have changed.
75-year period is a pretty long period.
Right, so long time. And we looked at everything over that time that met the technical definition of a bear market. And we have a graphic for this in table form that we can put up on the screen. I'm not going to read every entry. I'm going to focus on the average value. So on average, in these 1, 2, 3, 4, 5, 6, 7, 8, 9 different bear markets, the decline that was experienced was 35%, so about a third of the starting value, and they lasted on average about a year, 12.5 months. They took then about 36 months to recover from the previous high. Now there's some variation between those. Sometimes they're very short. The COVID bear market, the decline happened in 1 month and it had recovered in 5 months. That was crazy fast given what happened in COVID. Versus on the other end of the spectrum, the 2008 financial crisis, that played out over 17 months, and it took almost 5 years for the market to recover, which is part of why that period was so painful for investors. It was very traumatic for a lot of investors. So that's kind of what you can expect, kind of, sort of, on average, based on historical data for the S&P 500, just to get your head around like what could potentially go on with the market. How long could it last?
And one thing I just wanted to add is if you look at the bottom, the averages, the average decline of these 9 bear markets is 35%. The duration lasts just over a year, and the recovery time is about 36 months. So It is not a fun thing to live through, but it's not the recovery is not as long as I think many people would expect. Another way of looking at this too is approximately every 8 years, you should expect a bear market.
What's the significance of going over that? Like, how do you use that information to deal with, what's going on the portfolio level?
So what you can do is there's two broad philosophies of investment management. One is I'm going to try to predict what's going to happen. You have to figure out like why it's going to happen, when it's going to happen, right? And make moves accordingly. So, I get my crystal ball, I shine that thing up, and it says, hey, tariffs are going to be bad, market's going down. I'm going to position myself, I'm going to get out of stocks, go on to bonds, bonds are rallying. That sounds really attractive, right? You get the upside, you get no downside, life is perfect. The problem is, we used to call it market timing. Now the marketers call it, tactical allocation. It's the same difference. But the problem with that is study after study shows it doesn't work. Most people who are trying to forecast are really looking in the rearview mirror. They take what has happened recently and they project that into the future. And so what they end up doing is chasing the market. When the market's running, they're buying in at a higher level. When the market's falling, they're selling at a lower level. Terrible way, in my opinion, of managing money. So that's the crystal ball method, not ours. If I had a crystal ball, it would have so many cracks in it, it wouldn't be fun. Okay, but the thing is, you don't need to have a crystal ball, okay? If you're disciplined, then you can navigate these markets and actually take advantage of the volatility. So one thing you do is you allocate money, right? You have different types of stocks, large, small, U.S., non-U.S., different types of bonds. You might have treasuries, short and intermediate and long. You might have private debt, diversify. The logic there is just try to smooth the ride out. We also have this framework where we just don't do it randomly. We do it in our all season allocation framework. And all this means is we had a previous episode on this, but what this means is that we have assets placed so that when inflation goes higher, some of our assets do well. If inflation goes lower, some of our assets will do well. If the economy is strong or weak, some of our assets will do well in those environments too. So what we're trying to do is develop this portfolio, this balanced portfolio, that no matter what happens, strong, weak economy, high, low inflation, we can navigate it with a decent return that's a more consistent return. And that's what most people are after, okay? That's something very, very unique to what we're doing. Then, of course, if you're a retiree, you want a balanced portfolio by adding some bonds, which will cushion the downside of the stock market. And we add some private investments that have unique return streams that can help a lot of times with returns, and sometimes they tend to be less volatile as well, so they can help the portfolio with risk-adjusted returns. Now, there's a big negative with private investments. They're less liquid. Sometimes they can be a little bit more costly, a little bit harder to understand. But if you use them intelligently in a portfolio, we think it can really add value.
And the cost, I think, that's a little subjective, just because if the returns justify higher costs,
sure,
then I don't think that you'd be too upset with paying a little bit more for that better return.
Exactly. The private debt funds we use, net of their fees, are yielding like 10 and 11%. Now, of course, that's subject to change. Okay, so you allocate. We do it very uniquely with our all season. Then what you do is you have security selection. And on our equity side, what we're doing is a very much a Warren Buffett-like approach. We're trying to find quality companies at reasonable prices. I know that seems really simple. There's a lot of work that went into developing our selection process, but that's it at a very high level. And theoretically, what that should do in a down market is help you, theoretically.
Okay. I have one question,
Okay.
and then I'm going to ask if you can maybe just give some comparison details, from a performance standpoint. But the first thing that I want to say under that, I know Ron used the crystal ball method, or predicting the future with the stock markets, which again, study after study show, people aren't very successful when they try to do that. If you do decide to go down that path, the other thing you have to keep in mind is that not only do you have to be right on when you exit the market, but you have to be right on when you go back into the market. So, you decide to sell now, go to cash, okay. Maybe the market doesn't go down anymore. Maybe it does go down more. You never know. Then all of a sudden, now you have the decision to make of when do you purchase back in, okay? Worst thing to do is purchase back in when the markets have recovered, because now you might even be buying higher than what you sold them at.
Yeah, and I'm sorry for interrupting.
No, go ahead.
So what's really interesting is if the market falls, say 20%, and you get out, and it follows another 10, you feel very glad you got out.
Right.
But the thing is, most people don't get back in when it falls 30% because the headline news is even worse. They're even more scared, so they're very comfortable.
Yeah.
So then when it starts coming back, some of the biggest rallies are at the bottom of the bear market. So there's not a clear signal saying, "Hey, we're done with the bear and we're into the bull." We have no idea.
Right.
And so what will happen is a lot of times the market runs past where you get out. And then a lot of people's minds set shifts to, well, as soon as it comes back to where I got out, I'll get back in. And sometimes it never gets there.
Right.
And so you have two decisions to make when you try to time it, like you said.
Yeah. The other question that I had was, or I should say, the question that I have is, we did discuss this briefly in the all-season framework episode, where we discussed how we use that framework to make investment allocation decisions. Do you guys have any new information, as the members of the investment committee, do you guys have any new information now that is influencing the decisions that you're making? Have you made any adjustments to the portfolio recently based on what's happening in the markets?
So I'll let Ron talk about the stock strategy. We have made a couple in terms of asset allocation. We made a couple decisions prior to this that have helped add value. The first one that's top of mind for me is that we had made the decision to extend the duration of our treasury exposure in our portfolios. What that does is, we did a podcast about bonds and interest rates, so I'm not going to go into all that detail right now.
Duration's a technical term.
Yeah.
So we're going to have to...
Maturity. I should have said maturity.
We're going to have to, put it in plain English.
By extending the maturities, by going into longer dated bonds, so more time before the bonds are due and the principal gets repaid back.
Sure.
We basically made that portion of the portfolio likely to go up more if economic conditions deteriorated, or expected economic conditions deteriorated. And so that has helped add value because the treasury portion of our portfolio with this tariff sell-off has gone up more than it would have in the prior configuration.
And I would say the way it's structured is our goal is when inflation's going down, the economy's slowing, bonds tend to do well. We want to do about as well as the benchmark that we're using, the aggregate index. When things are kind of stable, our goal is to do better because we have a higher yield, and when rates are going up, because when rates go up, bond prices go down, we definitely want to do better then because we still have a little bit of a less interest rate sensitivity and we have more income. So we're very comfortable with how it's set up, and our timing was absolutely incredible.
And I just want to emphasize, because we said timing,
exactly,
we talked about making changes, and it's like, well, where's your crystal ball then? We're not basing that decision based on like, oh, Ron and Nick think that there's going to be a recession, so therefore we need to do X. We're basing it on the fact that we're looking at those yields relative to that maturity and specifically that interest rate sensitivity measure I described, duration. And we're saying, well, gee, we're getting better compensated to take that exposure now. And there's a benefit if the economy does slow down. So there's just value there is what we're basing that decision on, not, oh, I woke up this morning worried about tariffs.
Yeah, no, I'm glad you...
It's just mathematical. It's just like, you can look at where you get the yield And our interest rate sensitivity, our duration, our average maturity, whatever you want to call it, was less. We're just kind of bringing it back to more normal. And again, our timing was very
right.
good.
I'm glad, Nick, that you made that point, because I didn't want the timing part to sound contradictory.
It can sound a little confusing because
Yeah.
it's like, wait, you just said.
Right.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
Anything that you want to talk about from like a performance standpoint?
Yeah, so Nick was talking about our bond. Let me go into the stock portion. So as we stated before, we have one investment belief, but we have different ways of executing that belief, different portfolios. One is a stock portfolio on the equity side. So I'm using
Let's back up really quick if you don't mind. Can you just quickly summarize, in case this is somebody's first time listening, what that investment belief is?
Sure. So what we're trying to do is get quality companies. Now we define quality as nice and profitable at reasonable valuations, right? Like you can look at it, there's a bunch of different ways to judge valuation, what you're paying for earnings, what you're paying for cash flows, the yield, all that stuff. And so reasonable valuations, nice and profitable, we want lower risk, and we want decent growth. It sounds like an ideal company.
Right, yeah.
And if you can find those all with 100 ranking, that would be great, but you can't. But
Okay.
you can get really good ranks.
Okay, so that's the belief. You
Yeah.
said we have a couple different ways of executing that.
Right. And so one is with the stock portfolio. It's a 68 stocks, and it's global in nature. And one is with exchange-traded funds. The exchange-traded funds are more diversified, but less focused, right? So the exchange-traded funds, what you're trying to do is overweight the good and underweight the bad, stated very simplistically, or very simply. And the other way with the stock portfolio is trying to focus on the best of the best, right?
Okay.
And so if you look, and I'm referencing my IRA because my one IRA is 100% in stocks in the stock portfolio. As of yesterday, year to date, I was down about 8.5%. And if you take the global equity benchmark, which is about 65% U.S. stocks, 35% non-U.S. stocks, so it's very relevant to where our portfolios are. That benchmark was down about 11.4, so we're almost 3%. We fell almost 3% less.
Okay.
And then if you look since inception, 2020 of that portfolio, we have outperformed by more than 4.5% on an average annual basis.
Are there any quick notes that you would want to make, in terms of like what you think is attributing to that outperformance?
It's fishing in a well-stocked pond. If you consistently try to buy Warren Buffett-like stocks, which are quality, reasonable valuation, decent expected growth, low risk, you tend to do well over time.
So in an environment like this is when that type of strategy will look really good.
Right.
But maybe, 2 years ago when the Magnificent Seven are, returning, they're making up 80% of the returns of the S&P 500, your strategy might not look as good then.
That's
because,
exactly right.
frankly, you might not even be participating in purchasing any of those
Right.
stocks.
We had been slowly decreasing our exposure, for example, to chip stocks, okay, or conductor stocks.
So would you say it's safe to say that the strategy is really meant to limit the downside risk, when everything is doing well? Can the stock strategy also do well, or are you always going to be competing against these high-flying stocks that are just going to be really hard to keep pace with?
Yeah, so theoretically, when things go, when there's a bear market, they can be caused by two reasons. One, valuation, which is kind of like during the tech bubble, but that's not as often. A lot of times it's something to do with the economy like now. And lower volatility stocks tend to do better when there's like a global financial crisis, right? So our stocks tend to be lower volatility, nice and profitable. On the other hand, if it's more of a downturn because of valuation, our portfolio tends to be more reasonably valued. And so theoretically, in both those environments, we should do better. Okay.
Okay.
It doesn't mean we will. We should.
And what about the upside?
On the upside, it really depends because, right after COVID, our portfolios totally outperformed. And so we can outperform in certain times and certain times not, but I can almost guarantee you we will underperform when the largest, most popular companies are outperforming. That's when we would probably not look as smart.
But you wouldn't want to be purchasing those anyway.
Right. And then our ETF portfolio, the tracking here, meaning is it more similar to the market? That would be more similar to the market because it would have some of those magnificent seven, but they might be underweighted compared to the market. And, so that, like I just picked one account that's in that portfolio, the accredited, we call Core Plus. And year to date, that's like down 9.1. And, the global index is down 11.4. So, not too bad. And, so we're very comfortable with what we've been doing with our equity side and also the fixed income side. Yeah.
So, and Nick, I'll give this to you. Without, predicting the future, maybe you can just kind of play both sides of the fence. What do you think this bear market has in store for us? On the bear case, the markets are doing poorly, and then on the positive case, the bull market side.
Before we get there, if I'd like to add this one more thing, or two more things. First of all, I mentioned two accounts. Okay, if someone's in the same portfolio, the returns are going to be very similar, but not necessarily identical. It depends on when they started, if they put money in or out. Okay, so there can be some differences. But the second thing is going back to our process. I mentioned about the crystal ball, but the way of dealing with volatility is something called rebalancing. Okay. Mm-hmm. And so what happens is that as the stock market is running up and getting more expensive, we're all glad to own stocks. But what we do is we start to trim them because they're getting overweighted compared to where we want them to be, getting more expensive. We trim them to buy things that are cheaper. That might be selling U.S. stocks to buy non-U.S. stocks, or maybe to buy bonds, right? And so then on the flip side, like now when the stock market has been going down and starts to become underweighted, we start trimming our safer assets, in this case, mainly the treasuries, to start buying stocks lower. So, what we do with our approach is we take advantage of the volatility. When things are running hot, trim. When things are doing poorly, slowly add.
And the end result is that you're basically selling assets when you're getting a really good price for them. Somebody else might be not necessarily buying at the right time, but you're getting a good price. And then you're buying assets that are cheaper compared to their fundamentals.
Exactly. And what this does is it helps you take advantage of the volatility. It makes sure that your risk of your portfolio is consistent. It's not going all over the place.
Right.
Okay. And so you don't need to have the crystal ball. It's just common sense. When something is getting cheaper, if it's a good asset class, add to it. If it's getting really expensive, trim from it.
And this is, I would say, highly, extremely relevant for people that are in more of a balanced portfolio in retirement, where you have assets in stocks and bonds, because that's where the rebalancing and the decision making comes in. If you're in a 100% stock portfolio, you're going to be limited in terms of what you can do. You can manage it like we're managing, Wyze Direct. We're actually looking at the fundamentals of these companies and making decisions on what you buy and what you sell. But the rebalancing is very important for when you have a balanced portfolio.
Absolutely, and I was doing it or we were doing it last Friday, and then yesterday Monday, and market's up nicely today. It doesn't mean it can reverse course tomorrow, but we look at rebalancing once a month, and then when the volatility picks up, we do it more often than that.
Nick, let's go back to the question that I had. We'll close out with this. So, what do you think? Again, looking at both sides of the fence, the positive and the negative, what do you think this bear market has in store for us?
Yeah. So did you want me to start with a negative that you said?
Let's start with the negative, so we end on a positive.
All right. So the negative is this really aggressive tariff regime stays in place. No countries are really willing to give. Negotiations don't go well, and there's a big hit to economic growth in the short term, and even inflation comes in a little bit higher, and the economy has to adjust. Companies have to adjust their supply chains in a major way, and the consumer gets hurt. That is not going to be great for the market, but I want to emphasize, even in that scenario, the market will eventually go up again. In that case, it could be more of a slow grind if all the stars line up against what the market would like to see happen. So that's kind of the the potential bear case in my view. On the positive side, if the administration either says, they won't come out and say they made a mistake, but if they come back and say, we're adjusting things and the tariff regime is kind of loosened up a little bit, the market will react very strongly to that immediately.
Yeah, and if it goes well, it will surprise people about how quickly it can turn around.
I mean, there was a rumor yesterday because of some stuff that was posted online and some stuff that was said on some of the talk shows from unofficial that there was a rumor that got started that they were going to announce a 90-day delay. And I think things popped up like 4 or 5%, like immediately on that rumor. So the market's primed for that news, right?
Right.
They really want to hear it.
Yeah. The other thing that I think could be a real positive is, like Ron was talking about the negotiating strategy before. If the intent of the administration is we're going to scare everyone so they come and want to negotiate with us, and ultimately the outcome of that negotiation is reduced trade barriers overall, that's not as painful as this, that will be positive in the long run as well. So ultimately, we don't know.
Let me just add to that. I don't know if that's Trump's plan, though, because it seems like he wants to have tariffs to bring income in, revenue to the government, and also to bring manufacturing, for example, back to the States. Okay.
It's kind of funny. Over the, I think it was yesterday, I was watching, I think it was right before the basketball game started, the national championship. I saw a commercial for Ford, and I saw a commercial for Jeep. And they were really leaning heavily on marketing to
USA.
say built in the U.S., made in the U.S., produced in the U.S. And I'm like, oh my God, like they are literally making a commercial based on everything that's happening right now. I thought it was crazy.
Right. Well, I just want to add something too. So, I don't really like the way he went about things. If he would have done something very simply, saying, okay, we're going to put a 10% tariff on all goods that come in, right? It's almost like a tithe, right? People can handle that. And it brings some revenue in. If our policies, our regulations are friendly, if our taxes are reasonable, right? If our energy costs are low, and there's a 10% incentive to produce here, companies may just produce here. Now, our workforce is more highly paid, but hopefully they're more productive as well. And so they might say, okay, we have to pay the workers more, but we get these benefits.
Sure.
That would be great, okay? And in certain industries where maybe it's national defense, you have to put a higher tariff in. You want to have shipbuilding here. You don't want China building your warships, for example, right? Or certain countries that are really cheating the system.
Right.
Maybe more aggressive. That's what I would love to see. But the one thing that does scare me about being too aggressive with tariffs, and I'll kind of end it at this, is that do you remember the cars that the United States used to produce? Not you wanted to remember, Ryan, but the cars in the 1970s and 80s were pieces of junk. And there was no competition. And so if the tariffs are too high, the U.S. companies don't need to be as competitive. They can produce junk that we need to buy. And so Japan came in with Hondas and Toyotas and all that. And all of a sudden, our manufacturers had to compete with them and get a lot better. So competition makes things get better, right, for the consumer. And I hope he doesn't go too far and take that competitive spirit away, because that could really hurt us long term.
What was that famous hatchback-looking car back in the day?
Yugo.
Yugo.
I thought you were talking about Ford Pinto.
Pintos blew up. Yugos weren't so good.
I remember.
I remember my parents had a Ford Granada Ghia, I think it was called. It was, and multiple years after we had it, the window wouldn't open. It was rusting out. I remember, I grew up in Dormont. I remember, going out in the street trying to repair, some of the rust spots. And we took it to Earl Shives to get it painted. I mean, so things have come a long way.
Yeah.
So that's just personal opinion on my side.
But you can tell from that exchange just there about the future, like a lot of opinions.
Oh, yeah.
Not sure. We don't know. We can speculate. Of course, we think about it, partly because clients want us to help contextualize what's going on for them. But that's all why we come back to this systematic process that doesn't rely on us as an investment committee and you as an advisor along with us saying, well, what do we think?
Yeah, my crystal ball, right?
Right.
So we'll leave it at this. We very research process, and it's applied very systematically.
And we back it with a financial plan too. And the financial plan, as we had mentioned in previous episodes, that's really the blueprint for answering any, question that you have. Hey, do I need to decrease my risk? Should I increase my risk? Do I need to spend less? Can I continue spending the same amount? Any question that you have, the financial plan coupled with our disciplined investment process,
They're tied
which
together, right?
Gets you into the right allocation. Those things are tied together. So for our clients listening to this, I'll be sending this episode out actually, I think next week. But what I'll do is I'll make sure that we include a link to our calendar in there so that you can book a check-in meeting if you want to talk about this further. And if you're not a current client listening to this episode, but you're curious to see, hey, does the risk in your portfolio align with your financial situation? I'll also include a link in there, and you can just use that link to book an introductory call, and we can begin the process of evaluating that for you once you schedule that call. We hope that you found this episode informative. Again, if you have any questions, just reach out to us.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.